Although there wasn't much movement on the main share market indices today, it's actually been a really solid month, with the ASX up 3% these past 4 weeks and hitting several new record highs, on expectations there'll be more interest rate cuts ahead. Though keep in mind, the reason why central banks like the RBA cut rates is because they're expecting the economy to slow down and unemployment to rise, so hardly things to celebrate. Now, today was the last day of reporting season, and there were some extreme reactions once again. For instance, Harvey Norman jumped 11.5% after the retailer announced a better-than-expected profit, while Virgin fell after the airline reported its underlying profit rose by nearly 30%. But investors were hoping for a bit more. And shares of Star Entertainment went up, even though this casino group posted another massive loss. And there are doubts about whether it'll even exist next year. Now, looking at the big picture, there are concerns the market is starting to look overvalued, especially with the ASX price-to-earnings ratio at its highest since 2021. So it basically means people have been willing to pay a lot of money for shares, even if their earnings don't necessarily justify their high price tags. Meanwhile, iron ore rose, gold and oil prices didn't move very much, and the Aussie dollar is buying 65.3 US cents. Now, just finally, Wall Street's S&P 500 hit another new record, even though its biggest company, Nvidia, earned 72 billion Australian dollars in quarterly revenue. Though its shares fell on concern the AI trade is looking a bit crowded. Shares in the US tech sector, which is dominated by AI companies, are certainly looking expensive. They're a lot pricier than their 10-year average, but nowhere near as bad as the dot-com boom and subsequent bust nearly 25 years ago. So question marks about whether it's starting to look a bit bubble-like. And that's finance.